Welcome to What Is Your Money Really For podcast. I'm Cody Braun and I have with me today
Jordan Bradford.
Welcome back, Jordan. I'm excited to have you with me. The last time we were together, we were talking about investments.
Yeah, excited to be back.
Yeah, good, because the investments were exciting stuff when you talked about them.
Well, I wish I could take all the credit.
So what we're going to be talking about today is what we call the money life cycle. And what that is just like people, money tends to go through a cycle. And we want to educate you on the first two sections of that money life cycle here today. And I'm going to be asking Jordan some questions because he's the man with the big brain and the glasses and the calculator. Not going to call you nerdy though. So I'm really excited to what you have to share. So if you are somebody who is just getting started or looking to transitioning into building wealth, those are the two sections that we're going to dive into the money life cycle today. We're going to save the post-retirement, the retirement, the withdrawal phase, and building a legacy for another day. So I'm sure we'll have you back again.
Yeah, sounds great.
Awesome. So if somebody's just starting out and getting started with their finances, which it doesn't matter if they're 20 years old, 30 years old, or 60 years old, everybody has to start somewhere. Can you help us understand what are some of the things that we need to look at or dive into more to really understand of how do we build this solid foundation to build wealth upon?
Yeah, that's a great question. And I wish I had my calculator with me today to show everybody the glasses and the calculator. You'll have to just believe the brain size, I guess. But no, really, I think when it comes to starting out, like you said, everybody starts at whatever age they start at, and it really doesn't matter. Obviously, the longer time you have to save up for any goal, the more money that should be able to build, right? It's compound interest. As your money grows, it grows more and it grows faster over time. And I think that the biggest first step everyone needs to make is making a commitment to save. And whether it's $50 a month, $100 a month, $1,000 a month, whatever you can afford to do, I encourage everyone to just start with that and keep building on that year over year over year. And anytime you have extra money to put towards your goals, put that aside and put that into your investment account or into your retirement plan. Something that's going to work for you and give you a sense of accomplishment as you see it build over time. But that's not the only thing, of course, right? We always talk a lot about investments and what to do with your money, but also there's some things like not to do with your money too, including, taking on unnecessary debt, right? Certain debt is good and it works for our situations, like a mortgage. Not a lot of people I know have, $500,000 lying around to buy a house, and that seems to be the going rate around in our area, it seems. So unless you have wild sums of cash sitting around, there's going to be some debt that you're likely going to incur at some point, and that's okay. But knowing the difference between good debt and bad debt is a great way to start on your journey towards really having financial independence. So that would be one of my biggest, recommendations, really, if you will, is, try to only acquire good debt that's going to be useful for you. It allows you to have a home. Right? Don't go and finance that luxury purchase you've been waiting to make. If you can't afford the $2,000 bespoke suit, then you probably should wait until you've got that money set aside to do so.
Yeah, absolutely. I remember a lot of times I see it actually, people coming out of college, right? They're in this of, hey, I made it through college, I get out into the real world, I'm making a real paycheck now. If they had any student loan debt, it's 6 months before they actually got to start making their payments. And all of a sudden I see this huge flat screen TV when I go over to their house, this luxury vehicle, they're paying an absorbent amount of rate in their rent. And I'm like, whoa, you guys didn't plan this really that well.
Yeah, you really, I think everyone should start with savings being the first amount of money that you allocate towards something, right? And obviously, let's say you're 45 years old and you're just listening to this and you're saying, I need to start saving now, that's a little harder to do, of course, because you probably have other things going on. You may have kids that you got to pay for, and they're pretty important. You got to take care of them first, of course. You got to take care of a roof over your head, some basic necessity things like that. But I think if you can earmark that savings first, it'll be out of sight, out of mind. And it's what I liked about when I first started working here back a little over 6 years ago. I just committed, I said, I'm gonna just start right away saving 10% into my 401k. Just out of sight, out of mind. I'll never miss the money that I never got.
No, great point.
And I think that that's something that we do a lot as a society, is we say, when I make a certain amount of money, then I'll start doing this, whether it's giving to charity, whether it's saving money, whether it's, buying some things that you wanted to buy, right? What tends to happen is we make money, we spend that money. What comes in goes out, and if you earmark it to savings or to giving to charity or something that's important to you, it'll go out in the right direction as opposed to just kind of leaking out, so to speak, right?
It's a great point. I know one of the things that I agree, when I started working here, I did the same thing. I was putting away 10% of my paycheck as well, and every time I got a raise, I actually would increase that amount as well. So
yeah.
It's a way that it just, as my lifestyle would grow, so would my savings.
Yeah, what I actually tell a lot of people is, whatever the amount is, whether it's 10%, 1%, 20%, whatever you can afford to do, make it a habit every year to increase your contribution rate to your retirement accounts by just 1%. Just 1%. You won't even notice the difference on your paycheck year over year. But imagine this. Imagine you were making $100,000, and in year one you contribute 5%. In 10 years, you'll be contributing 15%. And if you get raises in there too, that even is more money. But even if you never got a raise in those 10 years, you'd go from contributing $5,000 or saving $5,000 a year to saving $15,000 a year. And you did nothing but increase by 1% a year, and your lifestyle won't even notice the difference. And it's a little easy way just to kind of trick your brain into saving more without feeling like you're losing out on something.
I love that. That's a great challenge for everybody here. Save 1% more year over year. And if you had your calculator, make you do the math to show us how awesome that number really would be over a 15-year time span. So let's talk about the savings portion of this, because you mentioned that is number one. What avenues should they be saving in, right? Because there's a lot of different ways they could do it. Should they be putting it in the bank? Should they be putting it into their 401k? Should they be putting it into an IRA?
Yeah, there's a lot of great ways to be saving money, and different things that you should definitely have in your repertoire, so to speak. I'll take a little bit from Dave Ramsey and his Financial Peace program, and I'd say the first thing you should do is just take $1,000 and put it into an emergency fund. Now, this emergency fund should be something probably at the bank is a great way to do it. I know some people who keep a little emergency fund in cash, like in a safe, but I'm not a big proponent of that. I think just put your money in the bank, in a savings account, not easily accessible. This isn't something that you should be able to go on your app and just quickly transfer, $50 so that you can have a nice dinner someplace, right? This is money that you should have to jump through at least a couple of hoops to get access to. And what this does is it just gives you a little bit of a buffer, right? When life throws us curveballs, and life will throw us curveballs.
Absolutely.
I love hearing people say, oh, this was an unexpected expense, and I'm like, really? You thought your tires were going to last forever? I'm like, you've put 80,000 miles on these tires. They were bound to be needed to be replaced, and we have to be putting some money in an emergency fund, and that's a great way, I think, just to start right away. And if you've got that already, or once you do have that in place, then it's taking advantage of your workplace retirement plans. Now, if you don't have one, that's another conversation we can have. But if you do have access to a 401k or a SEP IRA, a simple IRA, a 403b, these are the most common workplace plans that we see. If you have access to those, that's where you should start putting away, as much as you're comfortable with. If you can do 5%, 10%, obviously matches come into play here. So if you work for XYZ Corporation and they match 3% of your salary, as long as you put in that much, right? You want to at least get to your match. So if your company matches 3%, you should at least put in 3%, because you want to take advantage of the full company match. If you can do 4 or 5, you're just increasing the amount of money that you're saving for yourself, of course. So do as much as you can, but at least hit that match in your workplace retirement plan. I think is the first place everyone should start saving. And then really, if you're just looking at what are the total amounts that you're eligible to save for. If you're maxing out a 401k or you're maxing out your IRA contributions, then let's look at, taxable investment accounts where you can put some money aside, have it grow over a long period of time, and treat that as though it's another long-term investment as opposed to, a slush fund that we can just tap into whenever we want.
So one thing on the company retirement accounts, I know there's a traditional and a Roth IRA. Does it matter which one you would invest into?
Yeah, those are two very, very different styles of saving for retirement. You have your traditional IRA. This is the most common. This is what people are familiar with their traditional 401k plans as well, where the money that you put in is before taxes. So you haven't paid any taxes on this. You're putting the money into there. You're getting a bit of a tax break, right? In the example of making $100,000 and contributing 5%, you're getting a $5,000 tax break today to put that money aside for retirement. Now, like anything else, right, the bill always comes due. So when you take that money out in retirement, that's when you're going to pay your taxes. So the general rule of thumb is, the closer you are to retirement, probably the more beneficial that is for you, because you're taking advantage of tax breaks right now and paying the taxes in the not too distant future. The younger you are, the more likely it is that a Roth vehicle is going to make sense for you, because a Roth account, whether it's an IRA or a Roth 401k, is after tax. So if you make that $100,000 and you want to make that same 5% contribution, you don't get any tax break today. So you're going to pay taxes on that money, and you're still going to put $5,000 into your Roth 401k plan, but now that money gets to grow tax-free for as long as you keep that money in that type of vehicle. And you get, at some point down the road, when you take the money out in retirement, you'll get the money that you put in plus all of its growth back tax-free, which is pretty awesome.
Wow, that is awesome. So if I understood that correctly, if you're getting started but you're closer to the, doing something different, right? You would say do a traditional. But if you're younger and just starting out, that a Roth IRA makes more sense long term.
Yeah, it's really just thinking about like your goals, right? If your goal is close, then the tax break now is probably more impactful than a tax break later. Whereas if it's a longer term goal, you can take advantage of paying the taxes now and letting the interest just grow, letting that compound interest work hard for you over a longer period of time. And you may turn your $5,000 into $15,000 or $20,000 down the road. And I don't know about you, but I'd rather have $15,000 to $20,000 tax-free and pay a little bit of taxes today than get the $5,000 deduction now, but then have to pay taxes on the $15,000 to $20,000 later.
Yeah, great point. So it brings me up to my another question that I have. So if you're just getting started, maybe you're working for a smaller size company, or you have a pension, and you're still looking of, do I need to even save anything if I have a pension? That's one question. The second question is what if my company doesn't have a 401k plan or a retirement plan that I can invest in? It's so easy just to, I'll do that when I get my next job.
Yeah, you bring up a good point. And fortunately, that's becoming less and less common these days, right? 20, 30 years ago, having a 401k at your company was rare. Not every company offered that. Only the real big, very successful companies were offering those. Now, we find that most places, even if you work for smaller organizations, they can offer a 401k plan a lot easier than they could before. But if you don't have access to one, it still is really important to be saving and putting away for retirement. Even if you have a pension, I run into this a lot with teachers actually, because teachers have a pension system, and generally the benefits are pretty strong. Now, we could have a whole different discussion on the quality of Illinois' pension system for teachers, but to this point they've been paying out their pensions and things have worked out well for the teachers. But I think it's really important to still be saving on the outside. And whether you have a pension or you don't have a pension, and as long as you don't have access to your traditional retirement plan, you can still use vehicles like a Roth IRA or a traditional IRA. And there's also some additional type of accounts that you could open up if let's say you own your own small business or you do something on the side. A lot of people do that now, where you might work for XYZ company, But then you have a side business where you make maybe $5, $10, $15,000 throughout the year. And this is just some little extra spending money for you. But this could actually be a great tax advantage for you in the long run too, by being able to open up your own, essentially your own workplace retirement plan through the small business that you have opened, and went from maybe being just a little side hustle you're doing to now a bigger part of your long-term financial planning.
Wow, you open the door into the next section, which is going to be building wealth, and we're going to get to that in the future. But you bring up a great point, right? Regardless of where you were at, you might just be graduating from college, you might be getting your first big career, you might be starting your own business, and there's strategies that you can employ to really build a strong foundation that will continue to help you build into really having some great wealth when it comes time and you're ready to do that. Is that fair to say?
Yeah, absolutely. I think there's so many more opportunities today for people to save money in different, more creative ways than there were maybe even only 10 to 15 years ago.
I love it. Well, if you took nothing else away than some amazing information that Jordan shared with us today, right? He talked about start saving and make a commitment, right? Commit to saving some money and putting some stuff away, and start maximizing or utilizing what you have available to you through your retirement plan at your company. And if you don't, there's other options that are available to you out there. Does that sound awesome?
That does sound awesome.
Yeah, you did a great job. So thank you so much for joining us on What Is Your Money Really For? If you have any questions, don't hesitate to email us or give us a call.